Hello everyone, and welcome to this special weekday Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising, with Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters across the franchised and independent dealer sectors.
Hello and welcome from Philip and I to this weekday special episode. Today we're delighted to be chatting with James Brearley, Chief Operating Officer of the Peter Vardy Group. James will be a familiar name to many listeners as he's had a career spanning more than 2 decades at senior levels with some of the biggest names in the industry, including Pendragon, where he helped grow the business from 8 to 350 sites, and was also managing director of the Stratstone business for 10 years. After that, he was the CEO of Inchcape UK and joined the Peter Vardy Group in June last year. So welcome to the pod, James.
Hi guys, good to meet you both. Just one little correction, it was actually prior to June last year, so it's about 12 months in, not 10, but yeah, good to see you both.
Excellent.
Does it feel longer?
This is the retail motor industry.
Yes, yeah. A year is a very long time, James, in retail, isn't it?
Especially when we're at Q2 in March already, April already, James. See, I nearly got it wrong then as well, forgetting I was already in April and thinking about March. But yeah, it's staggering already, like you say. So, I mean, it's great to have you on the podcast eventually, James, and thanks for joining us. Basically, as an update on what's been happening in the Peter Vardy Group. So, way of a quick recap, and you might correct me on some of these, so hopefully I'll get these right, James. So, Peter Vardy Group was launched with Vauxhall in Perth in 2006 by Peter Vardy, the son of the industry legend Sir Peter Vardy, MD of the Reg Vardy Group. The Scotland-based business has since grown by acquisition to become one of the UK's best-selling groups, ranked 32 in the latest AM100 on turnover of 590.5 million, operating currently 9 sites across Scotland and representing BMW, Mini, Jaguar, Land Rover, Porsche and Aura, and as well its own multi-mark cars and vans supermarket operating currently in Motherwell. And James, you joined, as you say, as a CEO in 2023. So do you want to tell us a little bit about what attracted you to the business and how the first 12 months have been going?
Yeah, for sure. So, I mean, well, first of all, so I left Inchcape with a plan to join another rather large retailer, which didn't come off for a number of reasons. And I've known the Vardy family, for a long time. I've known Sir Peter, obviously, for a long time, and Peter, and we've always got on particularly well. I met both of them, funnily enough, at NADA a year ago, and we had a lengthy discussion about some of the issues that were facing Peter in his business. As you're aware, he'd come out of Vauxhall and developed his car supermarket business a couple of years ago, which was actually a really good business when he did that. And then, of course, like a lot of car supermarket businesses, COVID came along and kind of changed the landscape. So we sat down, had a chat. Would I be prepared to come and join them for a period to see if I could help them reshape the business and make it much more sustainable and more profitable? So, yeah, I mean, clearly it wasn't a difficult decision to make. So I agreed to join sort of between 12 months and 2 years was the initial view. And we thought we could make quite a bit of difference in that period, which I believe we have. So that's how I came to be here. I mean, one of the things I would kind of point out to your listeners, one of the things that attracted me about coming to this business is the whole concept, Peter's absolute belief in selling so that you can give. So if you look at the work and support that the family and the foundation do, particularly supporting young people in Scotland, it's actually quite phenomenal. So the idea of making money to give it away to really good causes is one that is highly attractive, and I think would probably be highly attractive to anybody. So that's why I joined.
So essentially, I mean, that was your brief then, really, wasn't it? To improve the business.
Yes. Yeah, absolutely. So, I mean, I go on to the car supermarkets, which were causing us some angst. We'd got a big business, as you've already described, with a number of large car supermarket sites. And when I say large, I mean the Glasgow site in particular was enormous. I mean, it was sort of delivering 500 to 600 cars a month. But to put a perspective on it, the group didn't have the footprint to be able to self-generate the number of used cars that we needed, and that was obvious. So we were entirely reliant on going out and buying lots of used cars in the marketplace. Prior to COVID, that wasn't so much of an issue. The group had got a really good buying operation, really good buying website, actually, that probably is better known than some of the more widely advertised buying websites in the Scottish area. So it used to be able to generate enough cars to fill its appetite. But as we've gone through 2020 and new cars registrations dipped, as we all know, for a good period, and used cars became much, much more scarce, then the problem the business had was it got enormous rising costs of people, rising costs of electricity, rates, you name it. And at the same time, it therefore, to cover those costs, needed to sell more and more, and was really, really struggling to fill, its own appetite for the number of cars it now needed to cover its cost base. So there were some fundamental difficulties. That resulted us in reshaping the business. So we basically, in short, closed 2 sites. It was very difficult, very, very difficult for the family who had never closed a site or made a redundancy. We did it in a very, very sympathetic way. We did our absolute best to protect jobs. And then more recently, we then refranchised a number of businesses and managed to sell those businesses on as really good going concerns. So, cut a long story short, we now have a very clean business that is focused primarily on premium businesses, and we have a big car supermarket in Motherwell that the group, frankly, can self-supply through its premium businesses. It's not difficult to make that business work.
And James, as you've outlined, as a business, you've built a good geographical spread across Scotland with sites in Motherwell, Edinburgh, Aberdeen, and Perth. And as you say, the group has very much a sort of premium brand focus. Can you tell us how that actually works for the business, that focus on premium brands?
Well, I mean, it would be difficult not to be biased towards premium brands, wouldn't it, with my background, I guess. But if you look at the return on sales, and actually more importantly the return on effort that you get from the brands you've just talked about there, these are businesses that if you run them really well and you do what the manufacturer asks you to do, and you get really good customer engagement and really good customer satisfaction and really good colleague engagement, guess what? You make an awful lot of money. And it isn't difficult to run. I've run groups, as you said earlier on, with 130, 140 sites, and it's actually quite difficult to get enough quality people across a large national motor group to be able to perform in the upper quartile. In a business of this scale, we should frankly be shot if we can't get these businesses to upper quartile, because we can actually go and touch them and talk to all the team literally every day. And if you do that, it's no secret that the returns that are available from those brands are really, really good. So from a profitability point of view for Peter going forward, the business is in rude health, actually.
And would you consider either adding premium brands to the existing portfolio or growing with your existing partners, or both?
Both. I mean, the short answer is both. It's that's never easy, and you can sit and debate when's the best time to buy, probably forever. The only thing I would say is that some of the premiums that get asked for BMW business, or certainly a Porsche business, were the one for sale, they're enormous. So you have to be very selective, and you have to be very sure of what the next few years would bring. I've got to say, if there are a whole host of reasons, regardless of what brand it is at the moment, I would be cautious just whilst we're going through this massive transition to electrification. Yeah, the short answer is, if for the right opportunity with a willing seller and a manufacturer that wanted us to do it, but of course we'd add brands in the premium sector, and we would add to the existing portfolio geographically. Yes.
And actually, that brings me on to the next question, James. At the moment, you're based across 4 geographical regions within Scotland. Would you like to increase that geographical footprint? Are there other parts of Scotland that you're actively looking at?
Well, I think in Scotland we're pretty well, as you've said, we're pretty well covered. I mean, we've kind of got the gateway to the Highlands right in the centre of the country in Perth, Edinburgh, Glasgow, and up to Aberdeen in the north. So we are pretty well covered. If the question was more, would you go south? Then of course there's some logic to going further south. But again, it absolutely depends on how far south that is. Is there some sort of benefited in that from a continuous geography point of view, and is there a brand that makes it worthwhile?
Might benefit you, James, for those trips up to Scotland.
Yeah. Well, I'm pretty. You know that. I'm pretty. I think I've operated in all.
I was going to say geographic aren't an issue for you, are they? To be fair, you're not used to one single territory, are you? So,
well, having spent a few years on the global exec with Inchcape,
yes.
When Stefan used to say, "I'll tell you what, we've got a board meeting and it's in Tokyo," or "I'll one in Estonia," you get used to travelling a bit.
Yeah, Scotland doesn't seem that far for you then, does it? To be fair, no. I think just as you mentioned obviously around the cars and vans, the supermarket operations that they're in Motherwell, and the way that supports the business in terms of that used vehicle flow, that being able to feed that business with the other sites that you've got. And obviously we talk a lot in the sector about the way the supply chain is shifting, the route to market in terms of the acquisition of used cars, etc. Do you see, as the business starts to grow, where that's within Scotland territory or starts to come a little bit further south, do you see potential growth in the future for similar setups to what you've got in Motherwell with that supermarket?
Well, let me talk in general terms if I can do. So if you look at it, and I've spent a lot of time working in standalone used car businesses of all types, and across the whole spectrum really. The key, frankly, is to be able to self-supply. So if you look at Sytner Group and you look at the amount of premium businesses they've got, and then you look at their car supermarket business, I'm not suggesting they don't have similar challenges to others. But what I do know is they don't need to be anywhere near as active out in the marketplace, buying from auction or buying from the general public, because they'll be taking an awful lot of cars in part exchange that they can recirculate through their footprint, because their footprint's balanced. They've got a smallish number of car supermarkets against an enormous machine that generates part exchanges. If you look at us, then one supermarket, we can justify that because we can buy, we can take almost every car in part exchange almost all year. So that makes sense. The only thing I would say to you is that it's really clear, and I think it's been clear for a few years actually. I think a few people have made a mistake in this area. It's really clear that you can make an awful lot of money out of standalone used car operations, provided you keep the overheads low, which means big sites with very little building. People behind the internet these days, or at least do all the research on the internet, as we all know. So you don't need main dealer style big sheds. That's where all the cost comes, heat, light, power, and rent rates and all the rest of it. So as long as you keep a large footprint and enough throughput, prep on site, and a reasonably small office or physical building, then these businesses can still make money today. But it certainly helps if you can self-supply, because if you think about it, cars that come in part exchange are the most lucrative cars because the customer delivers them to your site for a start. You get to see them at least twice. So, if there's an issue with them, you can do something about it there and then before you actually buy it. And generally, you buy them, at a reasonable price relative to the price that you'd pay at an auction, with transport costs and all the rest of it attached to it. So, clearly there's an opportunity going forward for car supermarkets, but just not in the way we had them configured. And I think somehow some other people have them configured.
And just as you may not want to answer this, but in terms of the supermarket connection with the franchise groups, because obviously you've got your premium brands, and that with the premium brands come the approved schemes and certain criterias and essentially expectations from a consumer perspective when they walk into a Porsche showroom or they walk into a BMW showroom.
Yeah.
Does that car supermarket give that flexibility for that vehicle that does fall outside of those parameters, marginally outside of those parameters, that it gives a slightly different consumer expectation when it's at a supermarket compared to, when they walk into a Porsche showroom?
Yeah, I think that's true. I don't think there's anything that's not true about that, but I'd probably look at it in a slightly different way. I mean, the way I look at it is, there is no question in my mind that a Jaguar sold through a Jaguar dealership or a BMW sold through a BMW dealership will sell ultimately for more money, and ultimately through the customer journey you'll make more money because that car is highly likely to come back to you for servicing. Now, providing you sell it locally, obviously, but you're likely to get more for the car because of the manufacturer schemes and the things that come with a manufacturer scheme. Where you're a group that doesn't have every brand, and we clearly haven't got every brand, then it doesn't make a lot of sense to trade cars through auction and pay an auction fee and a transport fee if you can actually sell it to an end user. You might as well take the margin yourself, whether that's retailing it through a car supermarket or setting up your own auction trade disposal website like the one that Rybrook operate really successfully. So, I mean, I think more and more dealer groups are starting to work this out and realise that, the 50, 60, 100,000 cars, whatever it was that they sold through the traditional auction method in the past is, it's kind of giving margin away. Somebody else is making an awful lot of money out of that.
Yeah, definitely.
You're listening to All the Chatter That Matters on a special weekday episode of Motor Trade Radio. Powered by Motors, the driving force behind multi-site advertising.
James, moving on to look at some of the wider industry trends that we're seeing. As a group that has successfully grown by acquisition, what's your take on acquisition opportunities across the sector? Because you must be hearing yourself of businesses that may be coming up for sale. What's the activity like out there at the moment?
Well, I think that's a really interesting question. I mean, there's a whole. Well, in fact, I'd go as far as to say, in 4 decades in this business, I've never known such an odd environment. So you've got 2 or 3 things going on, haven't you? You've got an awful lot of people who are, have kind of built their pension fund up called property attached to their motor business, and good luck to them, who are sitting there saying, we're really uncertain. We don't know what the market's going to bring. We've had COVID. That's caused us some issues in terms of cost base. We've now got electrification. We're not quite sure where that's going to go. And actually, is it a good time to sell? So you have got a number of people sitting there, no names or anything, who are, looking at selling individual businesses and small groups. At the same time, you've got this bizarre period, right? So, I worked for a company that was absolutely at the forefront of consolidation for 2 decades in the sector. And, maybe we were too early at it and under-resourced, who knows, from a financial point of view. But, we've seen more large-scale group takeovers, haven't we, in the last 2 years than we've seen for the last 10. And that in itself gives some issues, because a lot of those groups that go through acquisition topped out. If you look at the normal rules of engagement with the brands, particularly the premium brands, and the kind of the market share that's allowable or comfortable, the manufacturers are comfortable with, then clearly a lot of those have been exceeded. So I have no idea what's going to happen there. But sure as eggs are eggs, whilst you've got large corporate activity going on, it provides opportunities. Whether those are opportunities immediately or over the next 2 years remains to be seen. But I remind everybody that we're all generally on 2-year rolling dealer agreements. Some of them, a few of them are 5 years. But that tells you there's going to be some churn.
And in terms of acquisition opportunities, is it something you're always looking at, you're always reviewing and getting approaches as well?
100%. I think Peter will tell you, from the first moment he set up the business, he he's had a whole number of opportunities that have come his way. I mean, Peter's done a fantastic thing, actually, in terms of growing his business organically without paying other people great premiums for their business. So I don't think there'd be any appetite for us to sit there and pay a huge premium. But if we can solve a problem for someone, then we'd certainly be on receive.
And I mean, turning back to the sector, I mean, we mentioned right at the start, James, that we're suddenly in April already. We ended the first quarter of 2024, and how you've seen a few quarter ones of years, haven't you, over the time, James, in the few decades. How are you feeling at the minute? How has the first quarter of this year panned out? I mean, you mentioned within the conversation, we've got the electrification, there's M&A activity, there's challenges in terms of stock acquisition, etc. How are you feeling Q1 in terms of either generally from your view looking at the sector or as a business? How do you think Q1's panned out in general?
So to answer that, I think if you'll indulge me, let me just go back 12 months. So if you run back 12 months, it was blatantly obvious. In fact, I said it on one of these similar podcasts 12 months ago. It was blatantly obvious that, and it has been blatantly obvious for decades, that the one thing that affects our sector is interest rate rises, right? Because of the way people acquire cars on payments, obviously. So interest rate rises were always going to have an effect. And the number of rate rises in the period that we had, whether you believe it was responsible or not, I guess is a debating point. But I think, the Bank of England managed to create death by 1,000 cuts, didn't they? But it was obvious that there was going to be some issues as we went into the back end of the year, second half of the year. And if you then coupled that, again, I said this time last year, if you couple that with, what was clearly an oversupply of electric cars, then, there were clearly going to be some issues. There was, values RVs of electric cars was going to drop. And the market generally was going to get tougher, both, I suspect, in the short term for service and for sales. And guess what? That's exactly what happened. And that's one of the reasons that we started to wind our stock down considerably around about August time last year. So we protected the business from, you could have sat there at the time and said, well, maybe we've lost some sales, but it was absolutely the right thing for us to do, to wind the stock down and to reduce our exposure across all engine types and across all model lines. So we were in a great position where we were actually buying again at the back end of November after there'd been a readjustment in the marketplace. So to come forward to answer your question, as the market was really tough, as we all know, in terms of consumer demand in the probably from August onwards last year's reality of it. As markets started to ease up towards Christmas, it felt a little bit better, actually. There seemed to be more activity. And as we went into January, we were able to restock with kind of other people's problems at a lower price point and take advantage of a rising market. And therefore, for us, January was buoyant, February was buoyant, and March was pretty buoyant from a used car point of view and from a new car point of view. Now, there shouldn't be any great surprise because you look at any stat, and clearly there was consumers putting off buying anything for the last 6 months of last year. So we equally shouldn't get carried away by the market being better in the first quarter of this year. It was probably likely to get better. Now, there's a load of economic reasons why consumers will continue to spend, and let's hope that inflation really is tamed, and let's hope interest rates do show some sort of a cut in a reasonable time frame as quickly as possible, frankly. All of which sets us up for a better 2024 than 2023. However, the spectre still remains, in my opinion, of the change to electrification. I think it's still, we've got some serious disruption still to come.
Yeah, and I mean, we look at on the back of, we're talking just on the back of the March figures coming out, and year on year, to your point, 10.8% up year on year, but still behind pre-pandemic normal March periods and Q1 periods, albeit a positive direction in terms of recovery. But retail sales are challenged, and probably to your point earlier, borrowing, cost of living, interest rates is still fairly expensive, isn't it? But do you think, looking at your brands that you represent compared to the wider market, do you think you've performed fairly healthily in where you need to be from? I mean, you mentioned your performance in Q1 in general for used cars. Do you think new cars is in the right direction and fairly buoyant for the brands that you represent?
Yeah, I mean, without being brand specific, I mean, we're in pretty good shape with the brands that we represent, and I think the brands would tell you that. To be fair, so I mean, we're comfortable with our performance, but that's probably an unfair way of answering your question about the market because, as I said, we can focus on these businesses literally every day. We can be in one of the sites. I mean, it's not nowhere near as difficult as it is if you're running Inchcape or Lookers or any other large group, for that matter. But if you step back to your bigger question about the market, you're right. The headline is market up 10.8%, but actually that's probably not really the headline. The headline really, I think, is that, as you said, retail demand is down slightly, whatever it was, 5% or whatever. But if you think about it, given the fact that the corporate market was up significantly, you'd expect electrification to be significantly up. And it was up, but it still only represents, and I think this is the real headline, electric cars in March still only represent 15% of all cars sold. And that's the key, because at the end of the day, that's still a long way short of the government's expectation of what the car manufacturers should sell in terms of BEVs this year. Now, in reality is those cars are going to get registered, right? Because there's that much money on the table to do so. All that's going to happen is, as we go through the year, you'll see more and more pre-reg activity on battery electric vehicles, and you'll see much more going on in terms of visible and invisible price reduction. Subsidised RVs, whatever it happens to be, depending on the brand. The reality is the market is going to be full of late plate depreciating electric cars as we go through this year. In fact, it's obvious that's going to happen. We can all put our head in the sand.
Yeah.
And then if you then look at the double problem, the other part of that is I don't know a single motor group who wants to take an electric car in part exchange today.
Yeah, I mean, it's to your point, it's the volatility, isn't it, that's creating the nervousness and risk and caution towards it because of everything that's happening, whether that's new brands, price adjustments. We only need to look back a week where, BYD and Tesla have both missed their production volumes and therefore have started to price adjust immediately, which then causes used car pressures and residual value pressures.
For sure. And you look at the value of some of these electric cars now, particularly things like Mini Electric, 2 or 3 years old. I mean, those cars are really good value for money at sort of 16, 17, 18,000 pounds. But still, dealers are reluctant to stock them because nobody's quite sure, as you said, on volatility, where they might be in 2 months' time.
And James, against that backdrop of volatility that you've just outlined in terms of certainly the used EV market, how is the group's transition to electric going? And what are you seeing in terms of retail demand for new and used EVs?
Well, this is a glib statement. I mean, I think there's two things to bear in mind. Right? One is in Scotland, it's a long way between major cities. So actually, range anxiety is probably acute in this part of the world. That said, there's actually a lot more electric charging points than you probably first think there is. So, the infrastructure in Scotland is getting much better. But as I say, there's still a long distance between towns. And of course, the temperature's not great either if you're in Aberdeen, right? So that's an effect on battery, range. So there are some particular challenges in this part of the world. But the short answer, the glib statement, and the glib answer to your question is, listen, electric demand is fine once cars get, if you take MG, for example, when cars get to, $239 a month, $239 deposit, there's demand for electric cars. When they're trading at a premium of 15 to 20% over an ICE equivalent, then there's not. So clearly, there's a cost issue and a value for money issue really going on here.
And as you start to see those volumes of used cars coming through the business, what sort of level of demand have you got for used EVs?
Same answer really. At a price, if you can buy cars at a right price point, and particularly EVs that are sub £20,000, there is plenty of retail demand for those cars. The problem comes if ultimately the monthly payment on the car is dearer than a diesel or petrol equivalent, at which point you're still struggling to persuade a consumer, regardless of do any presentation in the world on the cost of diesel, petrol versus electric charging. It's still a tough ask when you look at some of the premiums that are being asked at retail point level.
Yeah, and especially if they're looking at buying EV for the first time, and they're comparing it with an ICE equivalent, which is available for a lot less per month. So it's an easier decision for them to make to stay with ICE, isn't it?
Well, I think the constant flip-flopping from the government isn't helpful. I mean, let's be fair. I mean, I'll be bold in saying this. I think most of us would probably have said that there's no way 2030 was ever going to happen anyway, with the history of all of our governments. However, the fact is that everybody, I feel really sorry for the OEMs because they clearly had to gear themselves up for 2030. And then all of a sudden, coming up towards an election, well, I'll tell you what, it's 2035. But to a consumer, what does that really mean? What it really means to a consumer is, a lot of people are facing it. Oh, right, my car's up for change. I'm probably going to have to go electric. To suddenly, do you know what? I can change my next car for a diesel or a petrol or a hybrid, and I'll worry about it when I know a bit more about it in 5 years' time. That's the reality of what they've done. So we are where we are.
And finally, I mean, you've mentioned, we've touched on a lot of this throughout this chat, but in summary, how would you sort of sum up sort of opportunities and challenges for both the sector and the business for the remainder of 2024?
So challenges first, right? Challenges I think are reasonably easy. Keep your cost base down, keep your stocks under control, which is probably no different to what any good retailer does on an ongoing basis. But now's not the time to, I think, pile a load of stock in and let go of your cost base, or decide that some great new piece of technology that requires some costing now, and don't worry, you'll get the benefit in the future, is worth investing in them. And that's a mad place to be, I think. So basics is keep the basics right is my answer to that. I think in terms of opportunities, I mean, the opportunities are enormous. I think we've outlined some of them. With any disruption, there's always opportunity, isn't there? And we've got disruption around ownership, from in two ends of the spectrum, and we've got ownership of retail businesses. That is, we've then got agency. Obviously, some people are in, some people are out, etc. That'll create opportunity in itself. And then we've got this whole electrification thing, which might say to some people, now's the time to duck out. So I think the opportunities are enormous. Just keep yourself, keep focused on what's really important. Keep your cost base low, perform as well as you can, keep your balance sheet tidy, and be ready and on receive when opportunities come towards you is probably where we would be.
Yeah, I mean, I couldn't agree more. I think you summarised it in your opening conversation that you are agile. The Peter Vardy Group is agile because it's size. You can react to your point that you've mentioned a few times, is that you can go and see everybody. You can go and touch and see the sites. You can be there, so you can react, can't you, to change and whether that's react to challenges that present themselves or grab opportunities when they become available to you. So I mean, it's fascinating at the minute to see the change that the Peter Vardy business is going through with yourself, with Peter, and the leadership team in terms of the way and the direction of change. So, I mean, it's been a fantastic conversation, and glad to have you on eventually, James, on the podcast. It's been far too long, but no, it's our pleasure. It's great to have you on and to share some of your thoughts around what's happening in the sector and what you've been involved with and Peter Vardy. So I'm sure that everybody this morning has been fascinating to listen to everything you've had to say.
Great, thanks for having me.
That's all for now. We hope you've enjoyed this weekday special. Many thanks to James for joining us for today's pod. We're back with the headlines on Saturday. Until then, it's goodbye from me.
And it's goodbye from him.
Thank you for listening to this special weekday Motor Trade Radio podcast. Powered by Motors, the driving force behind multi-site advertising. Philip and Curtis will be back with the week's big motor retailing headlines on Saturday. Live, on demand, wherever you are, on your podcast feed.